US equity market performance this year is driven by only 5 stocks. You want to know what the consequences are? This year US equity markets have done great, but if you look at the chart, this has been driven only by the IT sector. That's one of the upper 2 lines. And the IT sector performance has been driven by more or less 5+ large US tech companies. And if you deduct those companies from the general broad US equity market performance, that's the bottom 2 lines, then you see that the broad market has not performed that well at all. And if you deduct from the broad equity market those handful of large tech companies and see what the rest, the other 490 something companies have been doing this year, you get the bottom line in the chart, and this performance is very similar to what Europe has done, which is okay, but not comparable. This great performance of large US tech companies this year has been driven a lot by this booming AI, artificial intelligence boom. People think this will drive the future. We are also very optimistic on this. This will drive productivity, this will drive earnings, sales for a handful of large companies that can employ this technique. So far, so good. But what can this mean for future performance if you look closer at the second chart? What you have here is, look at this first bump on the left side of the chart. What you see here is how expensive was one of the poster child companies during the internet boom, where everybody was sure they are gonna make big money out of the internet boom. We are talking about the years 1999, 2000. The company is one of the largest router companies. They were building the backbone of the internet. They have been doing great business-wise in the last 20 years, even after 2000, when the IT bubble, as you know, has popped. What you see in the chart is the valuation of this company. Yeah, to get me right, great company, great products, great sales going forward. But in the year 2000, when this first hump is at the peak, this company was tremendously expensive. Everybody was sure this is the future. Everybody wanted to buy it. It was very expensive. What happened the next 20 years? Valuations came down. And this company was underperforming the broad market for the next 20 years. Why is this relevant? We have now a little AI boom. Some people are sure there are companies that they trust, they have the right products, they will drive the backbone, the technicals of the artificial intelligence boom. And I've brought you the same valuation, which is now the right-hand bump in this chart. That's the same valuation figures for one of these large artificial intelligence poster childs. And as you see, they are now almost as expensive as these internet poster childs were in the 2000 bubble. What does it mean in our view? You can go on buy this company. The point is, you should not rely on this handful of large, everybody knows them, tech monoliths to drive future performance. We, in our view, for instance, would be more confident if you can identify in the second and third tier of companies, those that are still smaller, less well-known, much cheaper in the valuations, and with much more growth ahead of them, and start investing there. That's either a lot of work, or you have a good active fund manager who does this in his funds, in a broad tech fund that is giving enough space to those upcoming growth companies. We would hope that future performance might be better than for these large, well-known names that are already very expensive. If you're interested in more videos of this type, ring the bell, give us a like, don't forget to subscribe to our channel. All the best, and we'll see you next time.